Hey everyone, and welcome back to the channel. Have you ever looked at your investment portfolio and thought, man, if I could just start over, what would I do differently? I get this question all the time, and it's a great one. The world of investing can feel like a maze, especially when you're just starting out. There are so many options, so much advice, and honestly, a lot of noise. So today, I'm going to pull back the curtain and share exactly what I would do if I had to start investing all over again from scratch. This isn't just theory. This is a practical, step-by-step blueprint based on years of experience, a few mistakes, and a lot of lessons learned. Whether you're a complete beginner or you've been investing for a while and just want a fresh perspective, this video is for you. We're going to cut through the complexity and build a solid foundation for your financial future. So grab a notebook and let's dive in. First things first. If I were starting today with $0 in my investment account, my absolute first priority wouldn't be picking stocks. It wouldn't be crypto, and it wouldn't be trying to find the next big thing. My first step would be to build a rock-solid financial foundation. This is the part so many people skip because it's not as exciting, but trust me, it's the most crucial. Without it, you're building a house on sand. So, what does that foundation look like? Two things: a high-yield savings account and an emergency fund. Before a single dollar goes into the market, I'd open a high-yield savings account and start funding an emergency fund. This is non-negotiable. Why? Because life happens. Your car breaks down, you have an unexpected medical bill, or you lose your job. If your only source of cash is your investment account, you'll be forced to sell your assets at the worst possible time, likely at a loss, completely derailing your long-term strategy. Your emergency fund is your financial seatbelt. It should cover at least 3 to 6 months of essential living expenses. Calculate what you need for rent or mortgage, utilities, food, and transportation, and set that as your goal. I'd automate weekly or bi-weekly transfers into this high-yield savings account until it's fully funded. The high-yield part is key because your money isn't just sitting there. It's earning a little bit of interest, fighting off inflation better than a traditional savings account. This single step provides peace of mind and the stability to invest with confidence, knowing you won't have to panic sell when life throws you a curveball. Okay, foundation is set. The emergency fund is growing. Now, where do I put my first investment dollar? If I had to start all over again, I wouldn't be trying to be a hero picking individual stocks. Forget trying to find the next Amazon or Tesla. The data is clear. Most active investors fail to beat the market over the long term. It's a full-time job, and even the professionals struggle. Instead, my first investment and the core of my new portfolio would be a simple, low-cost, broad market index fund, or ETF. Something that tracks the entire S&P 500 or even a total stock market index. Think of it like this. Instead of trying to find the one winning needle in a haystack, you just buy the entire haystack. By investing in an S&P 500 index fund, you instantly own a tiny piece of 500 of the largest, most successful companies in the United States. You're diversified from day one. The beauty of this approach is its simplicity and effectiveness. You're harnessing the power of the entire market. You benefit from the collective growth of the economy without needing to become an expert stock analyst. The fees are incredibly low, which is a huge deal over time. High fees are like a parasite that slowly eats away at your returns. By choosing a low-cost index fund, you keep more of your money working for you. This strategy, championed by legendary investors like Warren Buffett for the average person, is the most reliable path to building wealth over the long term. It's not flashy, but it works. Now, let's talk about how I'd invest. It wouldn't be by trying to time the market. Waiting for the perfect moment to buy is a fool's errand. I've seen so many people sit on the sidelines with cash, waiting for a market crash, only to miss out on years of growth. The truth is, nobody can consistently predict what the market will do tomorrow, next week, or next year. So, my strategy would be incredibly simple and powerful. Dollar cost averaging, or DCA. I would set up automatic, recurring investments into my chosen index fund every single week or every 2 weeks, right after I get paid. It could be $50, $100, $500, whatever I could afford. The amount isn't as important as the consistency. Here's why DCA is so effective. When the market is up, your fixed dollar amount buys fewer shares. When the market is down, that same dollar amount buys more shares. Over time, this smooths out your average cost per share and reduces the risk of investing a large lump sum at a market peak. It removes emotion from the equation. You're not making decisions based on fear or greed. You're following a disciplined, automated plan. This set it and forget it approach ensures you're consistently investing and taking advantage of market volatility instead of being scared by it. It turns market dips from a source of anxiety into a buying opportunity. Starting over, I'd automate everything and let the power of compounding and DCA do the heavy lifting for me. So, the core of my portfolio is a broad market index fund. But would I stop there? Not entirely. Once that core position is established and I'm consistently contributing to it, I would consider adding a second layer of diversification. If I were starting over today, my next move would be to add exposure to international markets. It's easy to have a home country bias and only invest in companies you know, but some of the world's most innovative and fastest growing companies are outside the US. By ignoring international stocks, you're missing out on a huge part of the global economy. Investing globally provides another layer of diversification. Sometimes the US market might be flat or down, while international markets are performing well, and vice versa. This can help smooth out the overall returns of your portfolio. How would I do this? The same way I invested in the US market, with a low-cost international index fund or ETF. There are funds that track the entire world market, excluding the US, or specific regions like developed Europe or emerging markets. For simplicity's sake, a total international stock market index fund is a fantastic one-stop solution. I'd probably allocate maybe 20% to 30% of my total stock portfolio to this international fund. This creates a more robust, globally diversified portfolio that's better prepared for whatever the future holds, no matter where in the world the growth comes from. It's about not putting all your eggs in one geographic basket. Now, for a lesson that took me way too long to learn the first time around, I would completely ignore the noise. Financial news channels, flashy headlines about the hot new stock, and your friend's cousin who supposedly made a fortune on some obscure crypto, I would tune it all out. Here's the reality. The financial media is designed to get your attention. Fear and greed sell. They thrive on short-term volatility and hype. The market is crashing, or this stock is set to triple. These headlines trigger an emotional response, tempting you to abandon your long-term strategy for a short-term gamble. But successful investing is boring. It's about discipline, patience, and consistency over decades, not days. If I were starting over, I would commit to checking my portfolio as infrequently as possible, maybe once a quarter, just to make sure my automatic contributions are going through. Constantly watching the daily fluctuations is a recipe for anxiety and bad decisions. I'd remind myself that I'm not a day trader. I'm a long-term investor. My timeline isn't next week. It's 10, 20, 30 years from now. I would trust the process I set up, the dollar cost averaging into low-cost diversified index funds, and let it work its magic over time. Resisting the urge to constantly tinker and react to the news is one of the most powerful things you can do to ensure your success. So let's recap the blueprint. If I had to start investing all over again from square one, here's the game plan. Step 1, build a 3 to 6 month emergency fund in a high-yield savings account before anything else. This is my financial armor. Step 2, my first investment and the core of my portfolio would be a low-cost, broad market index fund like an S&P 500 ETF. I'm buying the whole haystack. Step 3, I'd use dollar cost averaging, setting up automatic, recurring investments to buy consistently, regardless of market conditions. This removes emotion and builds discipline. Step 4, once the core is established, I'd add an international index fund for global diversification, allocating about 20–30% of my stock holdings. Step 5, I would ruthlessly ignore the daily market noise, the hype, and the fear-mongering, and I would trust my long-term plan. This strategy isn't about getting rich quick. It's about building sustainable generational wealth in a proven, stress-free way. It is a framework that allows you to participate in the growth of the global economy without needing to be an expert. It prioritizes stability, diversification, low costs, and a long-term mindset. It's the advice I wish someone had sat me down and given me on day one. It may seem simple, but in investing, simple is often the most effective. I truly hope this breakdown gives you clarity and confidence on your own investing journey. It's the exact path I'd take today. Thanks so much for watching. If you found this helpful, please hit that like button and consider subscribing for more straightforward financial content. Let me know in the comments what your biggest investing lesson has been. See you in the next video.